As a continuation of Chapter 13 about gross profit method, and to apply the concept which I had just discussed in the previous video, I will now be discussing the multiple choice problems of Chapter 13, but only the even numbers. So to start, with problem 13-2, we have the company provided the following information for the current year. So we are required what is the estimated cost of missing inventory at year end. So we are given the beginning inventory, purchases, purchase return, flip in, sales, sales discounts, and sales returns. At year end, a physical inventory revealed that the ending inventory was only 420,000. So this is the actual count. The gross profit on sales has remained constant at 30%. So since we are using the gross profit method of finding our estimated cost of ending and looking for our missing inventory, it is necessary that at the start, you should look for how your gross profit is computed, or what's the basis of computing your gross profit, whether it is on sales or it is on cost. So it is stated that it is on sales. So if it is on sales, then our net sales must be the 100%. Our gross profit is given. So therefore, we will assume that our COS rate must be 70%. So after getting the COS rate, you need now to compute your GAS, because take note, your estimated ending inventory is the difference between your GAS and your COS. So your GAS, of course, is your beginning plus purchases less purchase returns plus your flip in. So that makes your 2,930,000 for your GAS, while your COS is your net sales. So net sales, we have 3,000,004. Only the return must be deducted. Ignore your sales discount as what I have discussed. So 3,000,004 minus 30, only the return. That is 3,370,000 as your net sales for gross profit computation. So 3,370,000 times now the cost rate of 70%. So your COS based on gross profit on sales is 2,359,000. Deduct this from GAS, you will get now the estimated ending of 571,000. So if the estimated ending is 571,000 and based on your physical or actual count, it was only 420,000 as stated here. Therefore, the cost of estimated missing inventory is 151,000. So that's letter A. The next is 13-4. On September 30, a fire at Elusive Company's only warehouse caused severe damage to the entire inventory. Based on recent history, the entity has a gross profit of 30% on cost of goods sold. So it is gross profit based on cost. So your cost must be the 100%, gross profit of 30, therefore your net sales must be 130%. A physical inventory disclosed usable damaged goods which can be sold to a jobber for 100,000. So we call that the net realizable value. When the goods are damaged, you should write them down to their net realizable value. So that is based on our LCM rule, or our measurement of inventory. So the following information is available from the records for the 9 months ended September 30. So you're given inventory beginning, purchases, and net sales. What is the estimated amount of fire loss? So the same formula, only that our COS this time is computed based on our net sales divided by sales ratio. So net sales divided by sales ratio because it is on cost. It is based on cost. So it is the COS that is 100%. In our previous example, it was based on sales. So it is your net sales multiplied by your cost ratio. So this time it is on cost, net sales divided by sales ratio. So our gas, of course, is your beginning plus your purchases. That makes your gas of 7,000,001. Your COS, dividing your net sales by the sales ratio, that's 5,006,000. So the estimated ending supposedly is 1,005,000. But there is still a usable damaged goods of 100,000. So therefore, the total loss is 1,400,000. So that makes your letter B. So we already have a comparison of on sales and on cost. Another is we have 13-6. On December 31, 2020, a big fire caused severe damage due to the warehouse of Clear Company. So you're given previous year and current year 2020. We are asked for the amount that should be reported as inventory fire loss. So at the beginning of 2020, the entity changed the policy on the selling prices of the merchandise in order to produce a gross profit rate of 5% higher than the gross profit rate in 2019. So meaning we need to compute the gross profit of 2019 so that the gross profit of 2019 plus the 5% increase expected in 2020, then that will be the gross profit of 2020. So undamaged merchandise marked to sell at 500,000 was salvaged. So undamaged, meaning it is still in good condition, but it is marked to sell, meaning it is with a profit. It is at sales price. So when we compute later on for our estimated fire loss, then it should be converted to cost, not sales price. Then another damaged merchandise marked to sell at 100. This is the sales price of the damaged merchandise, 100,000, but estimated to be realized only at 10. So therefore, we need to write down the 100 into 10,000 only. This is only our recoverable cost. So to compute now our inventory fire loss, we need first to compute for our gross profit rate of 2019. So we will compute for our gross profit. So we don't have beginning inventory for 2019. So our purchases minus your return will serve as your gas. Your gas minus your ending. So take note, you're not given here the ending, but of course, we should understand that the beginning inventory of 2020 serves as the ending inventory of 2019 because the ending of 2019 is just carried forward to 2020 as beginning inventory. That's why it should be 1 million for the ending. So our gas minus our ending, that makes your COS or your cost of sales or cost of goods sold. Cost of goods sold minus your sales will give you your gross profit. So the gross profit now is 1.5. Take note that gross profit here is silent. So we will use your gross profit on sales. So computing now the gross profit rate of 2019, it is the gross profit as computed of 1.5 divided by sales, of course, of 6 million because there's no return or there's no sales return. Huh? So our gross profit rate for 2019 is 25%. And we want a 5% increase in 2020, so our 2020 must be 30%. So using this now, the 30%, if our gross profit is 30% and our net sales is 100 because it is assumed to be on sales, so our COS rate must be 70%. So we'll compute the 2020 gas, so it's beginning now, plus purchases, less your return. That's your gas of 8.5. So here, your COS now must be your sales multiplied by the COS rate of 70%. So that's 6,000,003. So gas minus your COS is now your estimated ending. That's 2,000,002. But there's again an undamaged merchandise of 500. But this is at sales price because it is marked to sell. So using the cost rate, we'll get the cost of this undamaged of 500 times 70%. That makes 350 only at cost. Then deduct also your recoverable of the 100. That's only 10. So your total loss must be 1,840,000. Okay. So again, you have to convert your physical count or your recovered goods only at cost, not at sales price. Because when we say inventory, it should be at cost. Next, moving on for 13-8. On September 30, a fire destroyed most of the merchandise inventory of Paragon Company. All goods were completely destroyed except for partially damaged goods that normally sell. This is again at sales price 100, and that had an estimated NRV of 25. So again, we'll use only the recoverable or the NRV. And undamaged goods that normally sell for 60. This is again normally sells, so meaning it is at sales price. We need to convert later on at cost. Inventory January plus your net purchases from January through September. So that makes your gas. Net sales from January to September, that's 5,600. So you are given 3 years or 3 consecutive years of your sales and COGS. So when you look for gross profit rate or your COS rate, check first if there is a trend in your gross profit or COGS. But if there is no trend, if there is no trend, meaning the company is just using the average percentage. So when you say average percentage, you just add the 3 net sales minus the 3 cost of goods sold. So your rate now, or your COS rate, is 6,750, the total of these 3, divided by your net sales. That makes your COS rate. If our COS rate is 75%, it means that your gross profit rate is 25%. So again, the problem here is silent as to our gross profit, or where to base our gross profit. So it is only on sales. So using this, let's compute gas. Again, adding these 2, less your COS, that's net sales, multiplied now the cost rate as computed here. So that makes your estimated ending of 700,000. Less now your recovered and damaged of 60, but this is at sales price. So convert this using the 75% cost rate. So that makes only the 45. Then your NRV for the 100,000 minus. So your total loss to be recognized is only 630,000. So that's letter C. So don't forget to reduce your sales price of undamaged goods into cost. The next one is 13-10. So for 13-10, the company on December 2020 had a significant portion of inventory stolen. The entity determined that the cost of inventory not stolen to be 100,000. So we are going to deduct this later on to find our stolen amount of inventory. Then we are given purchases, purchase returns and allowances, sales returns and allowances, and beginning inventory. Take note, the account is sales returns and allowances. As what we have said, once the allowance is included in the sales return, the same must be deducted because it's difficult for the entity to segregate the allowance from the sales return amount. So that's why the whole amount is deducted. Take note that we are only prohibited to deduct sales allowances and sales discount to compute net sales, but not your purchase discounts nor your purchase allowance. Okay, so to compute for gas, your purchase allowances, purchase discounts, they are deducted. So what is now the cost of the stolen inventory? Take note the problem did not mention again as to the gross profit rate. So if the problem does not provide for the gross profit rate, then you are going to compute the gross profit rate. And if it is silent, again, just use your gross profit on sales. So if it is on sales, then gross profit divided by sales or net sales. So we need to compute for the gross profit. Gross profit is equal to your net sales, of course, minus your COS. So we need to compute your COS by deducting your ending from your gas. So meaning we will start from gas. So we'll use 2019 information to compute for our gross profit rate. So gas is your purchases minus your returns and allowances plus your beginning. Okay, beginning. So 2 million plus 5 minus 2, that makes 6,000,008. This is your gas. Gas minus your ending will give you your COS. Ending, where we get this ending. Again, your ending of the first year is the beginning of the second year. So we will use the beginning of 2020 as ending of 2019. That's why our COS is 5.6 million. 5.6 COS minus from net sales, you will get now the gross profit of 2.4 million. Get our gross profit rate. It is your gross profit divided by your net sales of 8 million. By the way, your 8 million net sales is 8,000,002 minus the returns and allowances of 200. That's why it is 8 million. So 2.4 divided by 8, your gross profit rate is 30%. If our gross profit rate on sales is 30, you have here, our net sales now is 100 because it is assumed to be on sales if silent because it is commonly used. So our COS rate must be 70%. So using this, we will now apply to 2020. So our gas for 2020 here, beginning 1,000,002 plus 5,000,002 purchases less your returns and allowances. So that makes your 6,160,000 as your gas. While your net sales is 7,880,000 minus your returns and allowances of 80. So that makes your 7,000,008. 7,800,000 multiplied now the cost rate of 70%. So that makes your 5,460,000. Gas minus your COS is now your estimated ending inventory of 700,000. Supposedly your ending is 700. However, there is a cost of not stolen that is 100,000. It's already cost, not sales price. That's why it is the 100 that is deducted. If the 100 is the normal sale amount or it is the sales price, then you need to convert this or multiply this by 70%. So again, it's cost. So deduct the 100, you'll get the amount of stolen goods or the cost of the inventory that was stolen. Okay, so it's 600,000, letter B. Moving on, we have 13-12. So we have here we have series of questions. We have 1 to 3. Requirements: what is the amount of purchases for the current year, amount of sales for the current year, and inventory fire loss for 2020. Okay, so we need to compute our purchases and sales for us to arrive at estimated fire loss. So we are given the information. On December 31, 2020, a fire broke out in the warehouse of Regatta Company, destroying all inventory. The following data are available for the current year. So we have the inventory beginning. We are looking for the ending. That's why there's no amount. The receivable, debit and credit, these are provided for us to compute our sales. Accounts payable, debit, and credit are also provided for us to compute for our purchases. We have now a collection of receivable, payment to suppliers, goods out on consignment at sales price. So meaning these are the goods that are already given to the consignee. So these goods are salvage, or they were not included in the fire loss. So later on, you should deduct them from the total ending to arrive at your fire loss. Then you have also salvage value of inventory. This is the NRV, or the recoverable amount of the salvage value of inventory. Okay, then again, the problem is silent as the gross profit. We will use the average method. So adding, this time it is the gross profit that is given. In the previous, it was your COS. So this time it's the gross profit. So sales minus gross profit will give you your COS. So total sales, adding the 8 million, your gross profit is 3.2, meaning our COS is 4.8. COS of 4.8 divided by your sales of 8 million. So our COS rate, this is COS rate, 60%. Because our gross profit rate is 40%. Okay? So first question, what is now the amount of purchases for the current year? So again, let's use your accounts payable ledger to compute for purchases. So accounts payable is normally credit, therefore your beginning must be on the credit side, while your ending must be on the credit side. Your since you are looking for purchases, so it's on the credit side because your entry for purchases is debit purchases, credit accounts payable. So we will put here payment to suppliers. Payment is debit because when you make payment, you debit accounts payable and you credit cash. So since you're looking on the credit side, we will add the payment and the ending, that's 2.1. So this should also be 2,000,001 as your credit. So 2.1 minus your beginning, then that makes your purchases. So letter A. For sales, the amount of sales, we will use the receivable. Your receivable, we have 480 and 440 as ending. So receivable is an asset, so it is normally debit. So our beginning is here. So that's beginning. Beginning, your ending must be on the credit side. Then when we collect, it's credit receivable because your entry for collection is debit cash and credit accounts receivable. So that's collection to 640. So we are looking for the sales. When we make a sales on account, that's debit accounts receivable. So this is where your credit sales. So adding your collection and ending because they are complete. So 3,080,000, the same must be your total debit. So deduct your beginning from your total debit, then the difference is your credit sales. Since there's no cash sales, then your credit sales is already your total sales. Okay, so as computed, what is now the fire loss? So we will compute now the gas. Your gas is of course your beginning inventory as given here, 500,000 beginning, plus your purchases as computed in number 1, that's 1.7, that makes your gas of 2,000,002. While your COS, of course, is your sales of 2.6 multiplied by 60%. So again, here is the 60%, your cost rate. So that makes your 1,560,000. So gas minus COS is your estimated ending. So estimated ending, minus now your goods out on consignment, because if these goods were already sent to the consignee, therefore, these goods were not included in the FAR loss. But the 200,000 here is at sales price again. So that's why the 200 should be written down into its cost of 60%. So that's 200 multiplied by 60 is only 120. Then the NRV of the 20,000 is given here. So this should be deducted to arrive at total loss. So from 640 minus 140, that makes your loss of 500,000. Okay? The next one is your 13-14. Okay, 13-14. But instead of this, I will be using the PowerPoint so that the solution later on will be clearer. So just wait. Okay, let's have this 13-14. In conducting an audit of the company for the year ended June 30, 2020, the CPA observed the physical inventory at an interim date, May 31, 2020, instead of year-end. The following information was obtained from the general ledger. So inventory beginning July 1, that's 875. Physical inventory May 31, 2020, that's 950,000. Sale for 11 months ended May 31, that's 8,000,004. Sales for the year ended June 30, 2020, so this is 1 month after the May, so that's 96. So the difference between your June and your May is of course your for the month of June sales. Purchases for 11 months ended May 31 before any adjustments is 6,750,000, while your purchases for the year ended June 30, so this is for 1 year, this is for 11 months, that's 8 million. Then we have here information for your possible adjustments. For letter A, shipments recorded in May and included in the physical inventory but recorded as June purchases. So take note that the goods are already received in May and they are already included in the physical inventory. So no adjustment in the inventory to be made because it's already recorded, it's already included. But since it was recorded as June purchases, which is supposedly for May, so our May must be added. Okay, so our May must be added. But while our June, the June purchases here is for the year ended already, so no need to adjust because it must be included for the year ended June 30. So only May must be adjusted. For letter B, so meaning we are going to add the 75,000 from 6,750 later on. For letter B, shipments received in unsaleable condition, unsaleable, meaning it's damaged, and excluded from physical inventory. So it's correct that you should exclude because it is unsaleable. Credit memos had not been received nor had chargebacks to vendors been recorded. Total at May 31, 2020, so meaning the company did not able to record the return. But since it is unsaleable, it is proper to deduct it. So total at May 31, 2020 is 10, while your total at June, including already the May, is 15. So your adjustment should be deduct from May purchases and deduct the whole amount that includes the May because the June is already the year end. But if it is only for the month of June, then only 5 must be deducted. But take note, our data is for the year ended. And your June ending must include the May. So it's okay that you are going to deduct the whole 15 from June. For letter C, deposit made with vendor. Deposit made with vendor, so meaning you make advances to supplier and charge to purchases in April 2020. Product was shipped only on July 2020. So what happened? Since the advances to supplier was charged to purchases, but supposedly it's not because it is an advance payment for the goods that was shipped only July. So meaning as of April, as of May, there's no receipt of goods. So it's not proper to record purchases. That's why your April and May, or your May and June, because the May is included already in June, so overstated. So you should deduct both May and June purchases because it is supposedly to be recorded for July because the shipment was only made July. For letter D, deposit made with vendor. This is again advances to supplier and charged to purchases in May 2020. Product was shipped FOB destination on May 29 and was included in May 31, 2020. Physical inventory as goods in transit. So when we say destination, title of the goods passes only to the buyer upon receipt thereof. So since the company here is the buyer and the goods were only shipped May 29, so meaning as of May 31, the goods are not still received. So it's not proper for the buyer or for the company to record it as a sale because they have not yet received the goods. So while they are still in transit, they are still the property or the obligation of the seller. That's why you are going to deduct from May. Okay, so you must also deduct it from inventory record because it was included. So deduct in May purchases as well as in the physical count or your inventory. Through the carelessness of the receiving department, a June shipment was damaged by rain. This shipment was later sold in June at its cost. So, meaning in the total sale for June, this includes 100,000 sold at cost. There's no profit. So later on, in computing your gross profit, you have to separate the 100,000 that is without profit because it was only sold at cost due to damage. Okay, so considering these adjustments, let's see what's the requirement. Okay, what is the amount of gross profit for 11 months ended May 31, 2020? Gross profit, again, is the GAS minus your COGS. What is the amount of sales for the month of June? So for the month only, not for the year ended. Then we have what is the cost of goods sold for the month of June, so month also, and inventory on June 30. So this is the inventory end. So in answering all of this, let's consider the adjustments. So let's make a ledger first. In our first item, okay, we have beginning balances. These are given in the problem. Then for number 1, if you could remember, this was included in the May. This was not included in the May, going back to the problem here. So shipment received in May, but included in June purchases. Okay, so that's why you have to add to your May because the May was understated while your June is already correct because it was recorded as June. So your June includes already the May. So it's correct. No adjustment on physical because it was already included in the physical count. The next one is this one. Again, this is minus from May, minus from June. That's 10 and 15 respectively. So 10 and 15. For the 20,000 here, this is advances to supplier for July shipment, but recorded as May and June. That's why you should deduct from May and June. So 20 minus minus. Then for the 55, Okay, this is also advances, but the term is destination again. So May, as of May, the goods are still in transit. So we will no longer reduce the June because probably after May, the goods will be received. So it's correct that it should be included in June. So that's why only your May and your inventory for May should be reduced. Because as of May, they are not still the inventory of the buyer, and the company here is the buyer. So for June, it's okay, no adjustment should be made. It's correct that they should be included here because after May, surely these goods will be received, and it's correct that they will become part of the inventory of the entity. So for adjusted inventory now, for May 31, we have 895 instead of 950. For purchases up to May, we have 6,740,000 instead of 6,750. While your purchases up to June, so this is not only for the month of June, this is for the whole year, so 7,965. So to answer your number one, we are asked here for gross profit, I guess. Let's see. Yes, it's the gross profit for 11 months. So for gross profit, 11 months only. So we'll begin with beginning. That's 875. This is given by the problem. Purchases up to May as adjusted here. So we have 6,740. So that makes your gas. Beginning plus your purchases, that makes your gas. Plus your ending as adjusted here. This is the ending as of May. COGS is 6,720. COGS minus from your sales up to May only. It's given in the problem. You will notice here is your sales up to May. So 8,000,004. 8,000,004 minus your COGS as computed here above. So the difference now is your gross profit of 1,680. So 1,680 gross profit, the answer is letter A. So take note that we are applying the gross profit rate. So let's compute the rate because we need this in the succeeding questions. Your rate for gross profit is 1,680 divided by now your net sale. Again, the problem is silent, so we just base your gross profit on sales. So we have 1,680 divided by 84, that's 20%. So if our gross profit is 20% and our sales is 100, therefore our COS rate or cost of goods sold rate must be 80%. In number 2, we are asked for sales for the month of June only. So your sales for the year ended June is 96. If our sales for 11 months ended May 31 is 84, so the difference is for the month of June. So that makes your 1,000,002. So the answer must be letter B. In number 3, what is the cost of goods sold for the month of June? So cost of goods sold without your profit, that's your 1,100,000. This is, I guess, given. Okay, 1,1. Okay, wait. Okay, sorry. Your 1,1 is based on 1,2. This is for the month of June. 1,1. 1,2 is minus your cost of the goods sold without profit of 100. So that's why 1,2 minus your 100, that makes your 1,1. 1,1 multiplied by the COS rate. Again, gross profit is 20 minus from 100. Therefore, the COS rate must be 80. So your sales price of 1,000,001 times 80%, so your COS with profit is 880. Plus your COS without the profit, this is the damaged goods sold at cost. So your total cost of goods during June is 980,000. So that makes your letter C. For number 4, what is now the ending inventory for June? So for ending, let's begin with beginning 2019. It's for the whole year. plus your purchases for the year ended June as adjusted. We have here 7965. So that makes your gas. Less your COS. Our COS is your total sales as of June. So as of June, that's 96. However, included in the 96 is the sale without profit of 100. That's why it's only 95. So again, 96 less the 100 without profit, that's only 95 times the cost rate of 80%. So that's your cost of goods sold with profit for the sales with profit. So plus your sales without profit, because this is already at cost. So all in all, your COGS is 7,000,007. So gas minus your COGS, that makes your ending inventory of 1,140,000. So that makes your letter D, dog. So again, number 1 is A, 2 boy, 3 C, and 4 is D, dog. So here are again the solution. So we have your gross profit for 1,680, sales for June for 1,000,002, your cost of goods sold for during June, that's 980, and the last one is your inventory and 1,140. Okay, so this ends our chapter 13.